Have you ever wondered why a currency rate moves? I bet it's the daily life activities that most of you have experienced to talk about, especially those who suffer from currency devaluation against a neighboring country. For example, like me, hearing many people around me talk about the rate of my country's currency, the Malaysian ringgit, which was actually at a 1-to-1 ratio compared to the Singapore dollar back in the 60s. Yet now, the Singaporean dollar has appreciated and gone up 3 times higher than ours. Today, I want to bring a little macro perspective of mine to explain this thing. Actually, it was all lie in the supply and demand. And when we talk about the supply and demand, we cannot skip talking about the market. So let's break it down. What is the market? I'm not sure if it's just me, but I don't usually hear people bring up this perspective. Most of the publication will just put down the news on the table saying something like this. The Federal Reserve is really hawkish, and then the USD went up. Yet one of the key elements is missed. If we could restructure the sentence in such a way, say for example, the Federal Reserve is really hawkish, so the market participates in the appreciations of the dollar and buys it. Hence, the USD goes up. Does this make a little more sense than the previous one? Now, you may figure that the players in the market, the speculators, will move accordingly to the news, which is correct. But let's dig deeper into the core. How does it work? Now, let's bring up the holy terms again, the supply and demand. Let's put it in simple words. Supply and demand is like this. Say for example, you have like 10 apples on the market, and then you have the 10 beetles in the market. The 10 beetles might all buy 1 apple each. Yet if you change the number a little, for example, now we have only 9 apples, but 10 beetles in the market who wants to buy an apple each. Now, assuming that 8 of the beetles each return home with an apple, the only remaining is that 1 apple with 2 beetles, possibly more, maybe like 3 beetles, another beetles that wishes to beat the apple, as there are others looking to bid for the extra. So now if we put it into an extreme condition where the situation of the market is such that a natural disaster happens like drought or apocalypse, for example, probably this single apple will be the only apple remaining in the market. Okay, in this condition, do you think the 2 beetles will beat the higher price for it? I'll leave this blank here. Try to imagine the situation and the consequences after. Now, similarly, instead of an apple, imagine the same situation happening for a currency, where the market actually had $10 notes, and 9 of them were bought and stored away already. Now, only $1 note is left on the market, and the demand for this currency has increased recently because of the interest rate hike from the Federal Reserve or etc. reasons. Do you think the dollar will appreciate? Now, of course, it won't happen exactly the same as we are living in the credit era right now. Money supply isn't finite anymore, and there are other competitors' currencies like, like the Japanese yen, the British pound, Chinese yuan, etc. Well, logically it's the same. The surge in demand for a currency pushes up the price, combined with the condition that the currency is locked. Okay, the money is locked within nationwide for circulations, making lesser supply in the market for trade. Say for example, if the country's economy is forecasted to be better in the future, more people are likely to circulate the money within the nation rather than trading for other currencies. Or there could be other purposes like collecting interest, investing in foreign stocks, etc. This will make the existing currency in the market more competitive as the demand surge and the supply is lesser, and then it will push up the price. And furthermore, if the demand sustains, these will more likely to push up the price further. And this is what traditional finance refer to as onshore and offshore currencies. The currency's part within the nature is called onshore, and then the currency that is listed on the market for sales is offshore, to be simplified. On the other hand, how the currency depreciate? Simple. Nobody wants it. And the holder flood the market with a mass supply for reasons like maybe panic over further depreciation or exchanging it out for better options or whatnot. Now this is how currency rate moves in the basic understanding. I hope you learned something new today, and thanks for watching. Bye.